What do you get for paying fees? We're talking about retirement planning, investment planning, managing your money. Why would anyone want to pay fees? We're going to talk about it coming up next. Northwestern did a study and their findings show that Americans reach retirement with approximately 15% more money, and they report feeling more at ease about their financial lives, all by simply working with a financial advisor. 79% of those who consulted a financial advisor described feeling confident in achieving their retirement goals. Then there's a Vanguard study that showed that hiring an advisor could increase your returns. They showed over a 25-year period that on average, working with a financial advisor causes you to earn more money. So there are two studies that show some interesting outcomes. Number one, people feel more confident because they're working with somebody. And number two, they may actually earn more money working with somebody. So let's take it a step further to look and see what actually happens when you work with a financial advisor. What do you get for paying fees? Well, the first thing you're going to get is advice. You want to work with someone who lives in this field every day. You don't. Someone who is up to date on the law changes, the tax changes, and the investments that are available to you. For instance, let's talk about charitable giving. With the new standard deduction being increased on your tax return, a lot of people can't write off charitable giving anymore. But did you know that if you're 70 and a half years old or over, you can actually give directly from your IRA? It's called a qualified charitable distribution. In essence, it lets you write off that charitable giving when you otherwise would not be able to. If you don't know that rule, you're going to miss out on this tax break. Working with somebody that's competent in all of these areas, it helps you get the most out of your retirement. When you work alone, you may miss important benefits like this. Now, the second thing you're going to get is planning. You want somebody to do a full financial plan to show whether you have enough to live at the lifestyle you want to live at. You also want the plan to encompass several different scenarios. What if you and your spouse live to your 90s? There needs to be a plan for that. What if you die early and your spouse, can they still make it to their 90s? There needs to be a plan for that. What if there's a long-term care event? What if taxes go up? What if the stock market performs terrible for a long period of time? You need to see what your plan looks like in each of these scenarios. If you do the planning up front, you can see that one of these scenarios doesn't work out well for you. There are things you can do now to fix it. There are prescriptive things that you can do now, things that you can fix. So by the time you reach the age where the issue may happen, let's say long-term care, maybe that's going to be a need for you. By the time you reach that, you've already prepared for it. What if taxes go up? Well, you've prepared for it. What if the stock market is terrible? You've prepared for it. The third thing you may get is potentially better investment returns. There are a lot of different investment strategies out there. Now, if most of your money is in your 401k or the TSP, you have limited investment options. There are a lot of other options out there. Just to name a few, there are biblically responsible investment strategies. These typically rule out investments in companies that don't line up with your values. There are sector rotation funds, which they put more money in certain sectors during certain times of the business cycle, and they move money to other sectors during other times of the business cycle. They are actively trying to earn more money. There are buy and hold strategies, where you're not making a whole lot of transactions, you're just buying for the long haul. There are strategies that involve stop losses that could put a limit on how much you could lose in the stock market. Inside of your employer plan, you're going to have limited choices, and that can be a problem. Now let's just say that you move your money out, you get a Vanguard account on your own. Well, what's the problem then? Well, the problem at Vanguard, there's too many choices. If you see here, Vanguard has 209 funds to choose from in the year 2021. Too many choices is just as bad as not enough choices. Having somebody guide you through the investment selection that can explain it in layman's terms is very helpful. One of the ways that I interpret that Vanguard study, where it says that you earn more by working with an advisor, is because the advisor can keep you on track and causes you to not jump ship just because the stock market's not going well. Advisors can explain the investment strategy in a way that you'll understand it and you'll stick with it for the long haul. And by sticking with it, it usually works out better. There's a Dalbar study I've seen that shows that the layperson, just the average investor out there that's investing their own money, seems to always buy at the wrong time and seems to always sell at the wrong time, and in the end doesn't earn much because of that. You know what? If you're getting value from this video, please hit the subscribe button so you can continue getting videos like this. Hit the thumbs up button to help YouTube's algorithm get our videos in front of more people. The fourth thing you get for paying fees is having someone do some tax planning for you. The big name of the game here is, what is your lifetime tax bill going to be? Are there planning techniques that can cause your lifetime tax bill to go down? Well, the compliant answer is maybe, but a lot of times the answer may be yes. And if you think about it, it makes sense. Would you rather pay taxes on your $500,000 traditional balance today, or pay taxes on $2 million balance 20 years from now? The taxes and the tax rates don't even have to get worse to see that the math's better. If you can pay taxes on the smaller balance, you'll pay a smaller amount than if you wait and pay taxes on the larger balance. So there are different accounts that are taxed differently. Some you pay tax on the growth as capital gains tax. That's just a regular non-qualified account. Some accounts you pay tax on everything. That would be a traditional IRA or traditional 401k, traditional TSP. Whenever you make a withdrawal, it is 100% taxable at your tax bracket. Now, some accounts you pay tax before you put the money in there, and then everything you take out in the future is tax-free if you play by their rules. This is a Roth IRA, Roth TSP. You need to hold the IRA for 5 years or at least be 59 and a half or both to be able to avoid that taxation, but usually those rules are easy to abide by. And when you abide by them, it makes Roth tax-free. Now, different scenarios call for different types of an account. For some people, it makes sense to use one account over the other or to shift money from one account to the other. One of the scenarios that you need to make sure you're planning for is, what if taxes get worse? If you're confident that taxes will get worse in the future, then it makes sense to hold money in certain accounts over others. Another thing you get with paying fees and working with a financial advisor is they can help make sure you don't do anything stupid. Now, the fancy term for this is behavioral coaching or behavioral techniques. The advisors can help make sure that you don't panic in a stock market crash. They help you not make short-sighted decisions that have negative unintended consequences. This is one of the reasons why every financial planner needs a financial planner for themselves. And why is that? You need somebody to hold you accountable. So whether it's taking withdrawals that are too large to sustain for the long term, whether it's making rash decisions when the stock market has a negative move, working with somebody that can hold you accountable to make sure that you're sticking to the plan to accomplish the goals that you've previously set. So there's value in that. So these are just some of the things that you get for paying fees. So why would someone want to pay fees? Because they're receiving a service that is worth some multiple of that fee. I mean, why do you pay for anything? Because you're receiving value worth more than what you're paying. Why do you buy the $1,000 iPhone? Because you see value. What about the $60,000 pickup truck? Because you see value. It's the same thing with using a financial advisor. A good advisor provides enough value to more than compensate for their fee. Just like in the Northwestern study, you should feel more confident and more at ease when working with a financial advisor. Another thing that's important is to look at your returns after fees. Some 401ks and TSPs offer low fees, but almost none of them have any services. They have limited investment choices. They have limited people that can help you plan. The TSP for you federal workers won't let you shift money to Roth. So if you want to do some of the tax planning, you can't do it. So yes, the fees are low, but are you getting much value? You have to answer that question. You want to look at historical returns after fees. Then look at some of the returns that you could get from an advisor that charges a fee and see, after you pay that fee, what would you have gotten? A lot of the time, these returns can be very comparable even after paying fees, and yet you get so much more services. In the end, achieving your goals is the ultimate definition of success. And so if you want to talk to somebody that understands the value that they offer for the fees that you pay, please reach out to Christy Capital Management. We help guide people through these decisions. Everyone wants to earn a reasonable return at their level of risk. That's fair. I would argue that making sure that your other planning items are taken care of are even more important than returns. Because when a plan fails, it's usually not because they didn't earn enough. It's usually not because they pay too many fees, but instead it's because they didn't plan well. One of the scenarios, like if you die early, and your spouse doesn't make it to her 90s, or taxes go up and you didn't plan for it. It's the lack of planning and having a scenario that was overlooked and it comes back to bite you. That's why retirement plans fail. Reach out to Christy Capital Management, go to christycapital.com, give us a call so we can talk about how we can help you figure out if you have enough. We can help you figure out if you have the right investments for your risk level. We can help you feel more confident about reaching your retirement goals. Until next time, I'm Mel Stubbs. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used, and if used correctly can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally, so seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.